So here's a quick little, this comes from the Internal Revenue Service actually published this that shows you how to do a sale of partnership interest. Now, this example is pretty complex in that it also has unrealized receivables. And what they want to do is show you that you also might have ordinary income that you have to take care of in the sale of a partnership. So we'll take this example. You can continue reading it if you need all the nuances, but if we just use the amounts in here and just sell the amounts that are capital gain, we can scroll down through here. Here's the working example, and then go all the way to the bottom here. So these are the items here that we're going to sell: the land, the building, and the goodwill for just capital gain treatment. And here's the details into the sale. And then you can see it's 48%, which is the 52 divided by the 108. That gives you the percentage when you sell it on installment sale. That's the amount of gain that you'll recognize each year, because you have your basis. You're not going to pay tax on the basis when you sell it. It's just the difference between what you sold it for and what your basis is. So this is your gross profit here. Now, you can also look at this as, so let's say there's you. And you have all of the partnership interest. And you want to sell part of the partnership interest to someone else. So you're going to cut your partnership in half, and this half of the partnership you're going to sell to somebody else. In exchange, on an installment basis, they are going to pay you back for that. So you've agreed that you're going to receive $108,500. You've got $56,000 into your part. That's your basis that you have in it. And then over the time period that you're going to buy it, you'll have made $52,000. So it's roughly half. So half of everything that you bring in, you're going to pay capital gains tax on. So let's say year one. So nothing happened. All you did was agree on a contract here. So what happens in year two? In year two, you're going to get a check. And let's say that check is for let's just say you're getting paid for $50,000 of it. Now that $50,000 to you, you're only paying capital gains tax on 48% of that. So 48% of this is what will go on your tax return as capital gains. So you'll show the sale in the first year, but when you receive the payments you'll report the profit based on the percentages that came from the sale. Now, the payment can be, this is representing the cash, but this amount could be from a bank, could be actually from the partnership, could be a loan from a family member. They might loan them the money as a separate event, and then they create this loan agreement. But the partnership transaction is just between the two people that are selling the percentage of the partnership from the person that owned the partnership to the person that's buying out part or all of the partnership.